All right. Do we want a motion to start?
Bruce moves.
All right, Bruce, thank you. Why don't we, John, if you don't mind, why don't we just go ahead and get started? And Liz, hi.
Hi.
You guys are first up on our agenda today.
Great. Well, we'll kick things off if that's okay.
Please, thank you.
Great. Well, thank you guys for having us today. It's great to see all of you. It's a little different seeing you on video and phone, but hopefully soon we'll see each other in person again. It's really hard to believe that it was this time last year. I think it was one of our first. It was our first meeting in April. That was our first remote meeting. So it's really crazy to think it's been a whole year since this all started, but hopefully there is a light at the end of the tunnel and we can see each all in person. Hopefully sometime this year, fingers crossed. But it's great to see you all on video. We hope everyone's staying safe, staying well. And it is great to check in for the first time of 2021. John Forelli, our Director of Portfolio Research, is here with me today. Most of you know John. John heads up a team of investment professionals that do an analysis across all of our strategies, really do an in-depth review and analysis for all our clients. And then again, for anyone, I'm Liz Sheeran. I'm the relationship manager on your account and happy to be with you all today. I'll start with just a quick update on the organization, and then I'll turn it over to John for the good stuff, for the update on performance and what's going on in the markets, what we're seeing. So if you all have the presentation, I can start things off on page 1 to just give you an update on the firm. Boston Partners had $88 billion in assets overall as a firm at the end of March, so at the end of Q1, and the premium equity strategy where you all are invested, and that had just about $12.5 billion in assets in the strategy. Both premium equity and the firm overall have seen positive inflows this year. It's a good sign as to the value reversion, and John will speak to that a little later on, but again, positive to note for the beginning of the year. And then as far as the team goes, there's been no changes to the premium equity strategy team. Julio is still the portfolio manager, and he is out in our LA office. He is still working remotely as well. You can see John and I are actually in the Boston office, so it's nice that we've been able to return to the office here in Boston, so some sense of normalcy, but we're hoping that the other offices will start to come back as well, so we are getting back to normal. But unless you have any questions on the firm or the team, I will hand it right over to John, and he'll start with an update on performance this year.
Okay, well, thanks, Liz, and hi everyone remotely. And like Liz said, we are anxious to see all you folks in person soon. On page 4 of the presentation is a page with performance historically as well as most recently. I'll focus on the first quarter. The portfolio return was about 5.8% net of fees, compared to the benchmark, which would be 50% fixed income and 50% Russell 3000 value return of about 4.1%. And if you use the S&P 500 instead as the benchmark, it would be more like 1.4% as the benchmark. So exceeding the benchmark in the first quarter, as well as over the 1-year time period. The performance of the portfolio is really strong, 36.4%, which I just want to caution you not to get used to 36% returns. As a reminder, this was a comparison to a year ago, right after the market had fallen about 35% in the first quarter of 2020. So we've had a nice rebound since that time, and we certainly appreciate your patience with us during those difficult market times, and we're certainly glad to gain back some of the monies that had been lost during that difficult market environment. Just further down on the page in the first quarter, just draw your attention to the fixed income return of minus 3.5% compared to the return of the Bloomberg Barclays aggregate index of minus 3.4%. Just to put that in perspective, that was the worst quarterly return of the fixed income market since 1981. So just give you an idea of where we were. And I'm sure Bruce remembers that 1981 was back when Paul Volcker was in charge of the Fed, and he decided to bring out inflation and brought short-term interest rates up to 18%. And that was a difficult time for the fixed income market. It's incredible to think that the first quarter of this year had similarly difficult returns. Turning to page 5, is very much similar performance for the police department. We've now crossed our 16-year anniversary with you folks, and we're certainly glad and happy for this partnership over that time period. I continue to marvel at this fund having a very simple 50-50 allocation between fixed income and equities. There are many complicated ways to create diversified portfolios these days, and I would bet over the last 16 years, you're easily in the top quartile of any fund that could have used much more sophisticated and complicated ways to look at market returns. So I applaud your simplicity as well as your sticking with your initial strategy that you acquired with us 16 years ago. You should. I'll give you all a group pat on the back for a job well done. On page 6,
we do the same to you, and thank you for the work you've done over the years. Thank you.
Okay, thanks, Kelly. Appreciate that. Page 6.
I just sound fundamentals also, not luck, okay?
Appreciate that as well. But it also takes patience from your investors, and we have not had the same patient investors over 16 years. So you take some of the credit as well. On page 6, you can see probably the most important page of the presentation, which is how much money do you have in your account for your retirement and your beneficiaries. And you can see the employees have just short of $100 million, while the police have just short of $60 million in the total account. And you can see that we continue to be maximum overweight equities in the portfolio relative to fixed income. That's not an unusual place for us to be. As you folks know, we're typically about 60% equities in this portfolio in this traditionally low interest rate environment that we've been in over the last really decade, probably. Page 7 is a quick review of the OPEB trust. We've been managing that portfolio for about 3.5 years, and happy to see the performance ahead of the benchmark since inception. It's been a difficult time period during this 3.5 years for value managers, as you are aware, and we've seen a nice rebound in value, which I'll talk about in just a bit. On page 8, we can see the assets for the OPEB trusts, about in total a little over $10 million between the two trusts during that time period. And again, we appreciate you giving us those additional assets about 3.5 years ago to manage for your beneficiaries. And page 9, we can see the analysis of dollar changes since the beginning of time with our funds. And these are always fun to look at. You initially gave us about $26 million in the pension fund, in the employees pension fund, and about $23 million in the police pension fund. You've taken out about $1.2 million out of the employees pension fund, and we've about tripled that return over that time period, getting about a $75 million return on about a $25 million net investment. And for the police, they've taken out a little bit more money. Now have a net investment with us of about $6 million, but that $6 million has grown about tenfold to about $60 million today. And page 10 just shows graphically what the returns look like. An initial $30 million of investment would have grown to about $152 million over that time period, compared to about $105 million for the benchmark. Now, this is just for the equity portion of your portfolio, not for the balanced portion of your portfolio, including the fixed income returns. But again, an additional $48 million of additional return, $47 million of additional return over that initial investment. I'll shift gears here a little bit, talk a little bit about growth and value. I know the last time we spoke together, there were some questions about growth versus value and where we were in that cycle, and how difficult it is for value managers at that time period to keep up with the broader S&P 500 market. And things have changed pretty drastically, almost to the day of our last conversation. On the left-hand side of the page, the blue bars would be the value returns, and the green bars would be the growth returns over that time period. And you can see over the last year, the green bar is a little bit ahead of the blue bar, meaning that over the last year, in most cases, value has just outperformed growth by a little bit, but it's really all been a result of the last 7 months. You see on the right-hand side of the page, focusing on the first two bars, Russell 1000 growth has been up a little over 7% compared to about 26% for the Russell 1000 value. So 19% outperformance of growth versus value, of value versus growth over that time period. A sharp reversal from the previous 3 years that we had witnessed as investors. Page 12 is a reminder of a trend that we started to talk about the last time we spoke, and that was we hadn't yet seen value outperform growth, but we had noticed within the value benchmark that the less expensive companies had started to outperform the most expensive value companies. And that was a marked contrast to the first quarter of 2020 when the most expensive value companies outperformed. And you can see in this chart here, in the blue bars, that's the quartile one would be the most expensive groupings of stocks. And in that poor market environment, the most expensive value stocks did the best compared to the least expensive stocks, which were down about 41%. But since that time period, since the bottom of the market on March 19th of last year, the less expensive groupings of value stocks have been up about 121%. And we've benefited from owning, certainly a good portion of the quartile 3 and quartile 4 stocks on this page. And you can see down below, during that time period, your portfolio has returned about 79.7% compared to about 68.4% for the Russell 3000 Value Index. So we've managed to outperform that index by about 11% during that time period. So finally, that focus on low valuation, which we preach to you folks every quarter, really paid off over that time period. And page 13 is a reminder. You've been with us for many of these time periods, not the first post-tech bubble time period, but all of the other time periods since then. But typically when there are these big dislocations in the market and we're kind of questioning, what's driving the market and do investors still pay attention to valuation? After those time periods, we typically have done very well in the market environment. And you can see post the financial crisis, you were with us. Our performance snapped back very nicely. The Brexit scare around 2015 to early 2016, after that time period, a nice bounce back. And then this most recent time period as well, due to the pandemic recession. So sticking to the disciplines does pay off. It's not always easy during those difficult market environments, but our disciplines have served you and our other clients well over our history. Any questions on the market direction or where we've seen the market so far? Guess I'll just wrap up these comments by saying, typically when we see value reversal from growth, it's a trend that lasts for, I would say, 2 to 4 years, maybe 2 to 5 years. It's not just a 7th month reversal. So we think that we're at the initial stages of a multiple year rally for value stocks versus growth stocks. Now that's assuming that we have a nice expanding economy and we all get vaccinated, and 6 months from now we're all comfortable traveling for the holidays, and getting back to a normal environment where all you folks are back in the office and we're not wearing masks anymore. And we certainly hope we're moving in that direction. Page 14 is just a quick reminder of what we do for you from as far as our discipline on the equity side, looking for the combination of low valuation, strong business fundamentals, and improving business momentum. We use quantitative models to measure each of these characteristics and use that as a guide for our fundamental research staff to recommend stocks for purchase and sale in your portfolio. It's a nice discipline, again, that we've been using since the beginning of our business here at Boston Partners 26 years ago, and a process that we refine over time and always try to improve. And to show how we put that philosophy into work, we can see page 15, the characteristics that are driving your portfolio today. In the valuation circle, PE FY1, that would be the price of your portfolio relative to the expected 2022 earnings. Portfolio trades at less than 14 times earnings compared to over 16 times for the value benchmark and about 20 times for the S&P 500. So certainly a less expensive portfolio with higher free cash flow yield. At the same time, we're not sacrificing quality, where we have a higher quality portfolio in terms of operating returns on assets and returns on equity compared to the benchmarks. And at the same time, positive business momentum, which is a bit tricky right now because there are certain companies that we're buying in your portfolio that haven't quite seen that business momentum yet because we're still at a stay-at-home environment to a large degree. But we would anticipate that business momentum to improve as we go through the remainder of 2021 and 2022. On page 16, reminder, this is an all-cap portfolio. So we're looking at different opportunity sets for the portfolio. Today, we have about 55% of the portfolio in large cap securities, about 40% of the portfolio in mid cap securities, and about 5% of the portfolio in small cap. You may be aware, but small cap and mid cap have by far outperformed large cap over this last 1 year time period. On the margin, we're seeing a few more opportunities in the large cap end of the spectrum, which is really a reversal from the last 3 years or so.
Hey, John, what does the turnover look like within the equity portfolio? You guys very actively trading, or is it more buy and hold? I know there's a lot of value, but how would you?
Yeah, so over the last year, we've turned over the portfolio about 30%, which is typically in the range of 25 to 40%, so kind of in the middle. Most recently, with the volatility of the market coming down a little bit and valuations having come back, in the most recent quarter, we only turned over the portfolio about 3.5%, so it's a very low time period of turnover for the portfolio. But overall, on average for the year, is about an average year of turnover, with higher turnover at the beginning of 2020 compared to the last 2 quarters. On page 17, we can see the current positioning of the portfolio on the equity side relative to the benchmark on the right-hand side. Your portfolio would be the blue bar, the green bar would be the Russell 3000 value, and the purple bar would be the S&P 500. In general, very much overweight healthcare. That gives us stability in the portfolio. There are more predictable earnings within healthcare, particularly pharmaceutical companies and health insurance companies. They trade at attractive valuations with very good free cash flow. And they look much more attractive to us than some other stable sectors of the market, such as utilities or staples or communication stocks or cable companies. Many of those companies look much more expensive with less growth opportunities. So we've really found some good opportunities within healthcare. On the more cyclical side of the market, we found some good opportunities within industrials, as well as consumer discretionary, probably 2 of the areas that we've added the most to your portfolio over the last year. And we continue to have a big position in financials, as we have for quite some time. We've shifted that financial exposure from property and casualty insurance, which tends to be a little bit more defensive, less credit sensitive, more towards banks, which are more credit sensitive, that we should be a bigger beneficiary of the improving economy, and certainly the steepening yield curve that we've seen recently in the marketplace. All in all, we continue to see good opportunities. Our research staff continues to come up with new buy ideas. I'd say compared to before the pandemic started, beginning of 2020, we continue to see more buying opportunities than we did back then. Back then, the entire market looked relatively expensive. But since the market sell-off, there's been lots of dislocations, and we've had some good opportunities to add to different sectors within the market. I'll use as an example, energy. We've added to our energy exposure here over the last 6 months. So some very good valuations there. And if the current capital spending plans by energy companies are held, we're going to have a shortage of oil in the world in 2023. Now, the reality is there's plenty of oil under the ground, but we'd expect to see additional exploration and production activity, additional drilling activity, which will help the companies that are in your portfolio, and still trading at attractive valuations relative to history. Finally, again, we run a diversified portfolio here. We currently have 150 holdings in the portfolio. Again, plenty of resources to be able to follow all of those names with our fundamental research staff of 12 folks who are sector experts, and also Julio Romalo, whose only job at Boston Partners is to manage this portfolio. And in these volatile times, we would rather own more securities rather than less to diversify away some of that company-specific risk during these volatile times. And that approach has paid off here over the last year. Any questions on the portfolio positioning? I will leave you to review pages 18 and 19 by yourself, but it's interesting to see where we've seen opportunities in the most recent quarter. A green diamond would be a new purchase. An orange circle would be a new elimination from the portfolio. Up arrow would be adding to an existing position. A down arrow would be eliminating an existing position. But again, a relatively low turnover quarter. Not a lot of activity. As I guess it really weren't the surprises that we saw during the first quarter were really positive surprises to a large degree from an earnings standpoint. That's what I've prepared, at least for the portfolio review as of right now. As far as the opportunities between fixed income and equities, that say still tilting towards equities today. The fixed income market, again, after a significantly negative return, we'll probably get a bit of a positive return in the second quarter in fixed income. That wouldn't surprise us. But overall, with inflation expectations at about 2.5% right now, and a 10-year bond yield of about 1.6%, we still have a negative real interest rate of about 90 basis points today. So that still, to us as investors, doesn't make a lot of sense that you're locking in for 10 years a return that would give you almost 1% less than the inflation rate over a 10-year period. So we continue to think that the opportunities are on the equity side of the market. Although equities don't look inexpensive relative to history, value equities look, I would say, modestly more expensive relative to history, while growth stocks continue to look considerably expensive relative to history. So it seems like focusing on value equities over the near term seems to be the right place to be.
Thank you, John. Are there any questions from anybody for John or Liz? No, I think, John, you did such a thorough review that everybody is all set. We thank you both for your time and for the continued hard work that you put into managing the portfolio. We appreciate it and have enjoyed a very long-term relationship together, and hope you guys continue to stay safe, and look forward to when we can resume our visits in person.
Yes, and thank you, Kelly, and the board. I'd just like to say that I often use this account, this relationship, as the paragon of what we like to create here at Boston Partners, is a long-term investment partnership. So thank you all for your support.
Thank you, John. Thank you, Liz.
Thank you, guys. Great to see you all.
All right. Bye-bye. Next up on the agenda, we have the review of the invoices. Did anybody have any questions on the expenditures for the first quarter? No? Okay. We'll move on then. That's just for review purposes. Next up are our retirement applications. Tony, I know you're always super helpful in doing a bit of a review on our behalf to ensure that everything looks in line. Did you have any comments to share with everyone?
Other than I could match all of Finley's results, so there wasn't anything that stood out to me as an issue, not only for the town, but also for the single police pension.
Okay, Great. Did anybody else have any other questions on the retirement applications before we move to vote? Okay, do I have an approval for the town?
I move to approve.
Okay, Tony moves to
Move.
approve. Do we have a second? Bruce, seconds. All in favor for the town?
Aye.
And we have one application for the police. Do we have a motion for the police?
So moved.
Kim moves. Do we have a second? Paul, and all in favor for the police? Michael, I'll take that red, or the red turning to green as the yes. Excellent. All right. I believe next up on the agenda, we had new business before we get to the minutes. Was there something specific under new business, or was this an opportunity for anybody to bring up any topic that they wanted to discuss?
Just a standard entry on the agenda in case anyone's got anything, Kelly.
Terrific. Okay. Does anybody have anything that they'd like to discuss or bring up for the board? Okay. Then moving along, we'll go in. We have two minutes to approve. We have the January 12th minutes, and then we also have the special meeting that was called on March 3rd. Regarding the January, did anybody have any comments on the January minutes? No, the only comment that I had, because unless I'm mixing up my dates, I don't believe that I was at the October board meeting. I think I had a work conflict. And so I don't believe I would have voted on the minutes. So I wanted to mention that.
I'll check the notes on that and change it if that's the case.
Okay, thank you. All right. So with that Karen will check on as sort of the one caveat. Otherwise, it doesn't sound like there are any other comments. So do we have a motion pending that check to approve the January 12th?
Bruce moves.
Okay,
Kim for the
Bruce for the town, Kim for the police. Do we have a second? I can second for the town. All in favor for the town? Great.
Favor.
Everyone, do we have a second for the police? Paul's second for the police, and all in favor for the police? Kim and Michael, great, and Paul. And any comments on the special meeting on March 3rd? Do I have a motion to approve for the town?
Bruce moves.
Bruce moves. Do I have a second? Caroline second. All in favor for the town?
Kelly, I
Aye.
abstain from both because I was absent.
Okay, noted.
And I
Thank you,
abstain
Paul.
from the town.
Tony abstains from the town as well. Okay, for the police, do we have, oh, that was just for the town. Sorry, I'm about to go into police and I just thought myself. Okay, I believe that concludes our formal agenda items. So unless there were any other elements or any other topics that people wanted to raise, I can make a motion to dismiss.
Okay.
Okay, sounds like we have a motion to dismiss. Can I get seconded on the dismissal?
I second you.
All right, all in favor, great. All right, well, thanks, everybody. Good to see you guys. Hope everyone gets a chance to enjoy some of this beautiful weather that we're finally getting. It's nice to get outside finally. And
All the
hopefully, I
finance-
don't know, you'll keep us posted on our plans for July, I guess, right? If we'll be in person or not.
Let's hope so.
Can you tell the finance committee they should roll back the mill rate as a result of our returns?
Good call, Bruce.
Good luck with that.
I know. All right, everyone. Thanks again. Good to see you. Bye-bye.
Bye.
Bye.
Bye.